There are 7 types of insurance business. Marine insurance is one type of insurance business. Marine insurance provides protection against any loss of marine peril. There are 5 principles in marine insurance policy. First, principle of utmost good faith. Second, principle of insurable interest. Third, principle of indemnity. Fourth, principle of causa proxima. Fifth, principle of loss minimization. 2 types of marine loss. There is total loss and average loss. The act implied in the insurance is Marine Insurance Act 1906.
In Marine Insurance Act, Section 17 stated that any information should be exposed, if not will be avoided by another party. For example, some information considered as common sense, and second, the information with by the insurer. I think it's stated when the insurance is provided by an agent and the agent is assumed to be know every circumstance unless it comes to his knowledge is too late. This is the example of the case, and the court held with the word of Section 18.2 will to be given their ordinary meaning. In other words, it was not necessarily make the contract as a result of the not disclosure of the figure.
I would like to talk about principle on insurable interest. A policy must have some insurable interest in the subject that she or she want to buy the insurance. This means that the policyholder should be suffer loss due to the damaged good and also should be benefit for all safe around. 2 examples you can see the difference. This is based on free on board and the cost, insurance and freight. We got 2 examples to let you see. Okay.
Principle of indemnity. The principle of indemnity is the compensation of insurance company paid to policyholder due to the expected loss listed in certain insurance policy. In marine insurance, we aim to reduce the financial loss to insured property or cargo in maritime transport. We have 2 ways to define the compensation amount. The first way is the cost of repair versus the sum insured. The cost of repair insured ship or cargo is payable only up to the sum insured, even the cost more than the sum insured. The second way is based on the percentage of loss. If loss is 100%, indemnity is also 100%, but when the loss is 30%, the indemnity also reduced to 30% of sum insured.
The proximate cost is the dominant efficient or operative cost. While determining the liability of the insured, the proximate cost alone and not the remote cost is to be considered. The insurer is not liable for remote cost even if it is one of the insurable risks. Therefore, if the immediate cost is an insurance risk for the occurring of which the insurer is to be paid, the insurer is liable to make payments or loss under the policy, otherwise not.
Principle of loss minimization is the duty of the insured to take all possible steps to minimize the loss of his insured property on the happening of uncertain event. The insured must take every conceivable measure and indispensable step to control and reduce the losses in such situations.
Total loss can be grouped into actual loss and constructive loss. Actual loss occurs when the safeguarded lot is physically demolished to such an extent that there is no possibility of recuperation of the goods. The safeguarded cargo is damaged that it stops to be a thing of portrayal guarantee, and the cargo is hopelessly lost. Constructive loss occurs where the cargo is damaged to such a serious degree that the expense of fixing and reconditioning of the merchandise is more than the value of the products.
Average loss is the loss less than the total loss, and 2 types of average loss, which is particular loss and the general average loss. The particular loss is the unpredictable loss incurred by the sea peril, caused accidentally and not voluntary. And the general loss is caused is voluntary to prevent impending dangers happen, expenses voluntary or huge sacrifice made by reasonable.